Okay, thank you, David. It's always a pleasure to be part of the Friendsgiving every year. So welcome everybody to the Synergy Traders number 42 Friendsgiving 2022 conference. My name is Doc Severson. I'm going to be talking to you about capturing consistent weekly profits with weekly options. All right, here we go. So what I like to do is I like to be very visual when I give presentations, and I understand that most people have things to do and easily distracted. So I want to keep you in the loop in terms of where I am. So follow the bouncing ball. You can see what topics I'm going to be going over today as we move from the lower left up to the upper right. It's not that we've seen a chart do that in some time, but you get the feeling, you get the impression here. So who am I? Who is Doc Severson? You may have heard of me before. You may not have heard of me before. I'm an individual trader and performance coach since 2005. I am that guy that quit a quote unquote successful career. I was working at a 3-letter acronym telecommunications company, about 17 years ago or so, and just hating life, right? It just, all we did was fight with the other divisions in our company. All we did was sit on conference calls all day long and talk about zero job satisfaction. So all of you that are still working a 9-to-5 job and dealing with the politics and the BS every single day, you have my admiration for sticking it out. I just reached a point where I just couldn't do this anymore. It was a point of inspiration to go towards trading and desperation to get away from it. And then finally, when I reached that point, and these are some of the techniques I'm going to talk to you guys about today, of being able to make an income from the markets, it was, I just burned that bridge, man. I just ran across it, burned the bridge, and just have not looked back since that day. So what happened to me along the way was I'm working at home, and all of a sudden you realize when you're trading from home in a home office, and many of you ran into this a couple of years ago, all of a sudden you go from this robust work environment with a great social structure and going out to lunch with your buddies every day, to all of a sudden it's you and the dog in the market. And it's quite an adjustment to make. And I'm sure many of you have had to do the same thing. So what happened was a lot of people found out that I had quit my job and I was trading for a living. And so they started knocking on my door and saying, could you show me what to do? And what I found was it helped me not only to become more accountable to what I was doing, and that improved my performance, but also I loved helping people, and to this day. So everything that I've done throughout my career has sort of come to a head to be able to help people understand these difficult concepts that are in trading, and they don't have to be that difficult. They can be simpler. And so that's why I wrote a couple of books here a few years ago, over the last couple of years. So first of all, Hacking the Holy Grail is on Amazon.com. And so this is the journey that everybody has to make to be able to think differently to become a trader, instead of just relying on linear logic that we all expect. Everybody runs through the same brick wall, right? It's like, wait a minute, why did the market do that? It's not supposed to do that. So what you feel, or what you realize after a while, is that you're not really trading against the market, you're trading versus yourself. And so that's what Hacking the Holy Grail is about. And then the multiple time frame analysis trading that I've sort of moved towards through these years of learning how to read price action, number one, and then understanding the energy of the market. Is it charged up? Is it ready to explode? Or is it exhausted? Kind of like what we're seeing today in the S&P. It's a little bit exhausted to the upside and is migrating to consolidation. That's Fractal Energy Trading. Again, both of these books are available on Amazon.com. You might have heard of me before at the old options linebacker, or at Options MD, or Theo Trade, or Doc's Trading Tools, or most recently Ready Set Trade. And so I've been part of several services. And what I'm representing today is working with a friend of mine, Dave Lucas, from a long time ago. We somehow went in different ways and we've returned back together again. So still a good friend. And I have a lot of respect for him. Dave Lucas runs 12minutetrading.com. And so we recently ganged up together and we're having a ball right now. So that's who I am. I'd love to know who you are out there at some point, but we'll get to that in a minute. So my purpose today is so many new investors are discovering trading these days in very perilous markets. These are not easy markets to trade, especially being in a bear basically through the entire year. I want to see today's small investor get started without being taken advantage of, without having to go through the same hoops that everybody else has to go through. There's one very narrow path to success in this field, and I want to see the little guy win. You don't have to join a herd. You don't have to follow a wild subreddit to win trades, but there is one very narrow path to making this work. So these weekly and 0-day option strategies that really have crystallized this year are one of the best natural edges that I've seen available to retail traders in a long time. My purpose today is to make you aware of them, show you some setups, in general, help you decide if this is something for you. So what I'm going to show you in the next, say, 45 minutes or so is an entire system. So I'm going to set the table for it so you understand the context for it, and then I'll walk you through the entire system. So by the end of 45 minutes, you've got that in your hands and you can run with it and do with it what you will. So why we're here? Why are we here today? Do I also play trumpet? No, that's Doc Severson. And that's probably one of the reasons why I've been given the nickname of Doc a long time ago, is everybody hacked up my last name. Severson, they called me Severson. And so the Doc just sort of went along with it. But somehow people sort of see me in a white coat somehow. I don't know what it is, but there you go. So why are we here today? Why are we taking time off of, hopefully you're not playing hooky from work, but why are we here talking about investing all day through the Friendsgiving? Everyone's trying to set themselves up for financial freedom, aren't we all? But using yesterday's methods don't work anymore. The old paradigm of investing was to continue to grow your pile of assets. So build up that big pile of assets and then live off the interest, right? Once you accumulated enough assets, you could safely live off the interest without depleting your principal. And the old standard was to build up $1 million and then you could live off 50 grand a year in interest at 5% APR. Oh, how nice it would be for if it was that simple. But the problem here is that the interest rates that we're getting, even though we have year over year inflation of what is it, 6, 7, 8% these days, you know, the banks are still paying up maybe 3% if you're lucky. They're well below the annual rate of inflation. So we're all backsliding. We're all going backwards into this. So over the years, there's been 3 really traditional sources of income, which is going to be what all your financial advisors are going to tell you to do, right? So unless you've got market knowledge, they're going to be talking to you about annuities. They're going to be talking to you about bond yields. They're going to be talking to you about stock dividends and reinvestment of those. But these just don't work anymore, guys. I mean, to some degree, they do work a little bit. Like, I'm not going to knock stock dividends, but it's not going to produce the income that you're really looking for unless you've got a massive pile of an account. So annuities lock you in for years to receive a small return. Bond yields are still low. We're still below 4% for these. Stock dividends can be upwards of 7%, but you got to pay for it with a lousy chart like this. So you're going to get no capital appreciation in order to earn 8.7% a year. Ooh, you're going to retire on that? I don't think so. So this means that if you follow the old paradigm of growing your pile of assets, but being able to make money on your money, it's no longer there. So retirees are going to be shredding through their principal in no time, wondering what changed, even though this has been happening for the past 2 decades, especially since we went to quantitative easing and 0% interest rates. Now, that was a great thing, right? So in the words of Private Hudson, what do we do now, man? Game over. Well, I don't think so. I think there's other ways that we can do this. We can create income. Income is what we once received through interest and dividends and bond yields. So how can we replace these lousy solutions with something that works today? Well, we're going to focus on passive income, first of all, which is earned without active participation. So this is truly making money on your money. And then there's active income. Requires participation on your part, requires some effort to earn that income. That means a job or active trading or something like that. So we can seek passive and active income to be able to replace what we were earning before. Now, can we do this through stocks? can we create income by trading stocks alone? They're still expensive even after the bear has done their dirty deed, right? It still requires a massive amount of capital to trade the market leaders. Day trading stocks requires too much capital for smaller accounts. And there's that nasty thing called the pattern day trader rule. If you're below 25 grand, it's extremely restrictive in what you can do. So I just don't think this is a good idea to trade stocks for income, especially with a smaller account. I don't think it's very efficient. And, there you go, right? So there's better things that we can do. Options are the answer. Using options allows us to replace our interest income from the old paradigm methods. We can seek passive income, turn ourselves into an insurance company, which I think most people would agree is one of the most conservative business models that are out there. These companies have been around for decades, if not well over 100 years, doing the same thing, which is taking risk off of their consumers, the policyholders, and charging them for doing that. So we can do the exact same thing in the market by setting ourselves up as an insurance company and collecting passive income. We can also seek active income. This is shorter term opportunities to either buy or sell options, using the leverage of those options to more efficiently use our capital. So to me, options are a perfect vehicle for creating income. Now, my assumption for today, unless I was going to turn this into a 2-hour webinar, David said no. So this is an advanced trading webinar today through Timing Research and Synergy Traders. I'm going to skip the usual background on options and get right to the strategies, if that's okay. So the question, how do we generate active income using these weekly option strategies? First of all, we need to set the context for this because I think this is really important. A lot of people start out by saying, okay, I was making 100 grand a year and I need to immediately, the very day that I quit my job, I need to be making whatever, 100 grand divided by 12. So whatever that number is, 8,000 a month, that's what I need to do. And so they go straight into it, seeking to earn $8,000 a month. And this is where we get into trouble. So what I want to do is share with you a concept of the $100 a day. So earning $100 a day, can you earn this income like a paycheck? It doesn't sound like much of a goal. And every time I give this presentation, I have some people saying, oh, $100 a day, that's only, 20 grand a year, 25,000 a year based on 252 trading days, blah, 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 right? And especially with all the overblown promises of vendors in this space where like, hey, join us and you'll make $5,000 a day, right? And so you might have made significantly more than $100 a day in your job. But what I'm telling you guys, and I've been doing this for a long time, you've got to start somewhere. And this is what retail traders need to learn to do, is to get rid of your ego, get rid of the linear logic that's out there, and start small, even if it's $10 a day. What's necessary for human beings to maintain a sustained effort is progress. If you have progress in your life, no matter how small, that will get you up in the morning, that will get you motivated, that will get you working in this thing. However, if you're making progress in the opposite direction, if you're regressing, you're not going to tolerate that for more than a day or two before you're going to give it up and say, well, this doesn't work. And this is what I see all the time from retail traders. We'll invest in a program, we'll spend some money into it, we'll take maybe 1 or 2 trades, and they don't work out. And so what do? We say, well, the system is no good, but hey, look at this bright, shiny penny over there that I heard about on a Facebook ad. This looks really great, and I like this person. So let's ignore this strategy and let's go over here because this looks like it's a lot more fun and it looks easier to make money with. And so we'll do the same thing over here. We'll take maybe 1 or 2 trades after investing into the program, investing a lot of time. And then those 2 trades don't work out either because we're probably trading not to lose instead of trading to win. And so we go thundering over here to this other bright, shiny penny. You guys recognize the system here. We all do this. We all do this. We all kind of go around in a big circle. Instead of getting 10 years of experience of trading, we get 1 year of experience 10 different times. And so this is why I think it's important to start small, get committed to something, pick one thing, start with a modest goal, continue to improve on it every single day. Now, if I was to challenge you, if I were to meet you in person, and if I were to challenge you and say, hey, do you think you can get 1% better at what you're doing with your trading strategy between today and tomorrow? I would hazard a guess that 100% of you would say, yep, I'll take that challenge. I can do 100. I can do a 1% improvement on my strategy. I can tighten up the rules. I can do a little bit more analysis, and I can improve my execution, and I can get 1% better between today and tomorrow. And then tomorrow you come back and you do it. You actually get 1% better, however you measure it. And I would say, okay, now do it again. Do it again tomorrow, and the day after that, and the day after that. This is the key. This is the holy grail of trading, guys. And most people just don't realize it is if you just pick one thing, start with a modest goal and continue to improve on it every day. This is where you get into these hockey stick curves of improvement, where you get 38% better at something or 38 times better at something by the end of the year. This is how you do it, is you stay small, dedicate to one thing, keep it simple, and just keep improving, keep pushing that stone up the hill. If you get 1% worse every day, you basically revert to zero by the end of the year. And we don't want to do that. So this is the key to success over time, not a different indicator, not a fancy strategy, nothing else. Nothing else that I'm going to talk about today is all that complicated. It's more about applying yourself in a very simple thing and doing it day after day after day. Now, this is not the only thing that we trade. We do use an income pyramid, so we will use some longer term strategies, the big slow ones, the big slow moving whales that swim below the ocean, right? So these generate passive income. We can also do this with stocks as well too, generating passive income with a majority of our capital down here, very slow stuff, but we don't get a whole lot of reps at this, and it's very simple stuff. So I'm sure a lot of people, many of you are probably already doing this. What we're talking about today is more up at the top of the income pyramid, whether it's futures or in this case, daily options, where we're trading a lot less capital, putting a lot less at risk, but looking for some really, really good returns that we can sweep into our longer term strategies. Now, your approach is going to be different than everybody else's. You're going to have a different level of capital, going to have a different amount of capital. You have a different amount of time. Everybody's got a different commitments to their time, and everybody's starting with a different level of knowledge. So a lot of people will say, well, this intersection of capital, knowledge, and time that I have is not very good, and I can't make money with this because I'm either capital constrained or I don't have very much time. And I'm here to tell you that you don't need all that much capital with the right strategies. If you risk manage them correctly, you don't need all that much time either. And that's kind of the point behind the 12-minute trading that we do. Maybe 12 minutes a day is all it takes. However, the knowledge is unlimited. So for all of you that are capital constrained, time constrained, maybe you're working a job, I would say, fine, can you come up with some capital and maybe start working on paper for right now just to get your strategy down? And meanwhile, what you're doing is you're saving up and trying to build up an account. Time, can you punch a window in your schedule 12 minutes a day to be able to trade? Find a lunch break once a day or some type of other break where you can just get away and do your own thing for 12 minutes. And then knowledge. Are you going to limit yourself to your knowledge, or are you going to get that 1% better every day, which I know that you can do and doesn't cost you anything to do that. So there's no limit on your knowledge. And I'm here to tell you that if you don't limit yourself on your knowledge, you can easily make up for any limitations on capital and or time. So everybody's approach is going to be different, but these are the basic 3 inputs that everybody uses. Now, it is easier with a larger account. There's no kidding, right? So you could just trade the wheel strategy on Apple with a big enough account, and that'll generate your passive income. But again, this is probably not the problem that I'm solving for you if you're listening to this. So today's focus is going to be on active income. We're going to talk about active income trades through the rest of this presentation using weekly options. We'll seek to make a specific income goal per day. And if we need to, if we have a small enough account, we can skip days to avoid pattern day trader issues if we're trading a small account. So there's ways that we can tailor this regardless of what we need. Okay, now we're going to get into, we're flying along here. We're going to be done here in just minutes. Let's talk about 0-day options. What are those? You may have heard of weekly options before. Most equities that are out there do trade, at least the bigger ones, do trade with weekly options. So you've got 18 November, which is a Friday. You've got 25 November, which is Friday. All of these are Friday expirations. It used to be, when I started in this business, we just had the monthlies when there was huge importance on the monthly expirations every month. And so we'd have all kinds of fireworks going on. Now it's all spread out to Fridays. Okay, so this has been around for maybe 15 years or so, weekly options. But now with the S&P this spring has gone to daily options. We have Monday, Tuesday, Wednesday, Thursday, Friday. And then the following week, Monday, Tuesday, Wednesday, Thursday, Friday. Every week now. This is where we get the terms 0-day options expiry. The NDX also has, this is the NASDAQ 100, also has 0-day option series, as does options on the S&P futures, Monday, Tuesday, Wednesday, Thursday, Friday. And as of this week, and I've been waiting for this one for a long time, but the spiders and the Qs have 0-day options starting this week. We got our Tuesdays, still waiting on the Thursdays to be printed based on their discretion, but it'll happen in the next week or two. And then we'll have 5 days a week on daily options for the spiders and the Qs, and maybe someday the IWM as well too for the Russell 2000. What I want you to imagine with these options is that there's a raging fire at the other end of the room. And I'm going to try to draw a representation of a raging fire. So work with me for a second here. And let's say that you've got an ice cube that you're holding in your hand. You're holding an ice cube in your hand. Now there's going to be certain level of passive melt just by the heat of your hands. And given enough time, that ice cube would eventually melt to zero, right? And so that kind of illustrates the time value or the extrinsic value of that option, which will go to zero by that closing bell expiry. Now imagine if you're walking towards this raging fire. The amount of heat that the fire gives off is going to vary with the square of the distance. So the closer you get, the more that ice cube is going to feel the fire. And so this is why you get this exponential curve to the downside. With this, the closer you get, the more that cube is going to melt. So that is today's options. I mean, that's the same whether it's a monthly option, but can you imagine this happening in the space of a day? There you go. Now, these are very sharp instruments. If this is your first go with options, this is probably not the place to start with. I would start with something simpler in the passive income world where you're selling something that's maybe 45 days out, maybe 60 days out, something like that. Very simple, very easy to manage. You know, just start with something slow. And it's like if you were playing baseball as a kid, if you're learning how to play baseball, don't step in the 80-mile-an-hour fastball batting cage first. Start out with a 40-mile-an-hour and get your mechanics of the swing down first before you step up to the next speed of pitcher. So consider extending the trade over a few days to slow down the trade. So we use 5 days. And if you want to, you can go out to something a little bit longer, a little bit slower, a little bit easier to manage if this is your first go around with options. Now we're going to get into the nuts and bolts of it. And I know all the engineers that are out there are like, okay, good. Finally, we're getting around to the strategies. I was like that myself. So let's talk about the strategy benefits of a neutral strategy, first of all. So for a long directional trade, if we go long on something, say like a stock, you're either going to see the price go up, you'll see it sideways, or it'll go down. Now notice the outcomes from each of these. This equates to a 33% chance of winning on an outcome basis or less, since an asset trending sideways shows opportunity cost. So if you're holding something and it's just not going anywhere, and this is like holding Microsoft for the longest period of time, just didn't go anywhere, right? That's opportunity cost. You could have had your money doing something more productive in some other asset. So this to me is actually a loss, as is the price going down as a loss as well too. So on an outcome basis, that's only 33% of the time you're going to be winning. Now, if we flip that around, if we sell that option to open it, so for a neutral options trade, you're either going to see the price go up, sideways, or down. In this case now, because of the fact that we're selling a wasting asset like that ice cube, this equates to a 67% chance of winning, since an asset trending sideways wins with a wasting asset due to time decay of the short options. So this makes a big difference to people if you're struggling to get going in your career and you can't seem to win any trade at all. And every time you go long, the price goes in the opposite direction and all that stuff, right? This to me was a breakthrough. All of a sudden I started winning all these trades. So learning to use the probabilities to increase your winning rate is one of the most liberating principles in trading. One of the biggest advantages of using options if you use them the right way. Let's talk about some specific strategies. The short strangle, this is where we sell. In this case, what we're doing is we're selling a put down here. So I've got a short put and I've got a short call. So short call, short put, this is the short strangle. This is the king of option selling strategies used by professionals. But the main problem is the huge margin required due to the unlimited risk profile. So this could technically go to zero, and this could go technically to infinity. And the risk profile of this is kind of tough. So if you ever put one of these on or go to put one of these on, you'll see that the broker wants a tremendous amount of capital for margin, unless you're somehow lucky enough to get portfolio margin. So there's lots of war stories out there for new traders getting blown out due to unlimited risk curves. Somehow, for some reason, they're always airline pilots. I don't know why it is, but it's always airline pilots that create these stories of getting blown out through short strangles. And they do great for the longest period of time, and then one trade, gone. So to fix that, we add an insurance option on each one of these, and we turn it into a high probability iron condor. That's what the HP is. The caps the risk at each side using these spreads, which also lowers the margin requirement. Yay, but it's not quite as good as the king, the strangle. For this style of iron condor, probability is increased by using a lower reward to risk. So we start off typically with somewhere like an 80 to 90% probability of success on this, but the reward to risk is not so good. Now we can fix that by going to a lower probability reward to risk. So the risk here can actually be defined by this R value here, which is the maximum risk that you're going to take on the trade. So this is one thing. What's great about this is the black swan proof type of trade where you don't have to worry about something that's happening outside of market hours that you can't hedge against. You don't have to worry about a limit down day or anything like that that you can't defend against. So these are good. However, they're much smaller in terms of the area that is going to be effective for you in terms of the price, the width of the trade. So for this style of condor, probability is decreased using a higher reward to risk. So with options, you never get exactly everything that you want. So if you want a high win rate, you're going to pay for that by getting a lower reward to risk. You never get everything that you want. If you want a better reward to risk, you're going to pay for that by having a lower probability of success. And then we could go fully nuclear with the iron butterfly here with zero width between the short option strikes. We just combine them together in the middle. So width in this case is sacrificed for speed. I use these intraday because they're so fast. They are so fast to produce profits. Now, the one thing I want to illustrate to you is that you don't need to learn 42 different fancy sounding option strategies. This used to be the way that people would sell programs, is like, hey, we've got more strategies than the other firm. We've got more. And the more strategies that you have, the more chances that you have to make money. Well, okay. I don't believe in that. I think just a handful of properly applied, correctly managed strategies will work to create consistent income, provided that you manage them properly. So would you rather be the carpenter that's just got a few hand tools and does excellent work, or do you want to be that guy that's got a whole garage full of tools but doesn't know how to use them, right? So you're following an insurance company business model. By taking risk out of the market, you're being paid for it by those that want to offload the risk. It's a perfect business opportunity. And this is how we're going to earn that daily income. So let's talk about analysis techniques for offense. How and when do we place these trades? Now, there's two ways of analyzing something. And if you're around for trading for any length of time, you'll realize pretty soon that there's two kind of religions when it comes to analyzing trades. There's the random walk, which is generally what I would say is anybody from Chicago that cut their teeth into trading pits or worked in a prop firm in Chicago is going to be more towards random walk. Implies this is that there's zero knowledge about forward price action. So forward price movement fits into a log normal distribution of price. So you don't know what the future holds. And you have no clue. And tomorrow's price action is totally random. And so again, most people that do this have drank the water from Chicago. If you go into the CBOE, the Chicago Board Options Exchange, you will not see one price chart in the entire building, not one. It's all numbers. Now that's quite different from the folks in the pit, are quite different from the folks that trade from home, because you don't have the luxury of seeing price discovery in front of your face as you did in the price pit, in the trading pit. So we've always had to do it through graphical interpretation of what's happening with the price through charting. However we do that. Now, technical analysis implies that we can project forward price movement or understand the probability for a forward price movement based on past behavior. Okay, so these people have a big problem with this. They say you cannot do that. All charts belong at the bottom of the sea with the rest of the sunken galleys, something like that. So to me, I think both of these are worthwhile used in the right context. These two schools of thought are religious extremes. Why not use both of them? So for random walk analysis, we can use the expected move. We can find a plus and minus one standard deviation distance from where the price is today with our chosen expiration. We can use option delta to find the probability of success that the market expects for that trade. What is the probability that the price will get in the money by expiration? So we want to place positions outside of this expected move. So you may have seen this before, that kind of probability cone that's out there. So if we say that this is expiration, the moment of expiration for those options, and this is T0 down here, this is time, and this is right now, then at any given moment of time, the longer that we allow the option to live, there's going to be more expected movement to this. So what we want to do is we know that these levels, we know what these levels are. We know what the one standard deviation price movement is from today to the upside and to the downside. So why don't we do this? Why don't we place our trades outside of this one standard deviation price movement? So that's the way that we can use random walk. And so we can see this in random walk. This is a Thinkorswim interface. We can see that When this was taken, the price was 39.93. The expected move was plus and minus almost 90 points. And so if we just do the math, right, if we just take this price and we add and subtract 90 points to it, and then we're going to have these levels here that we know that we need to place the trade beyond. So this gives us a 68.2% probability envelope of success. Locating positions outside of there will help. There's no guarantee that the price won't come after it, but we're stacking probabilities. We're just doing what we can to place our positions out of harm's way. Now, we can also use technical analysis with this. Our goal, again, is not to predict the future with TA. Many try to predict the future, and this is usually people that don't have that much experience with technical analysis or trying to predict the future. We use TA to augment the statistical analysis of random walk. So what's our goal with neutral options selling strategies? It's to enter and exit when there's an absence of a linear trend. We don't want to be setting up a trade here with that freight train about to run over our position. Or we don't want to be entering to the downside when this is about ready to puke to the downside, right? So we don't want to be doing this. We want to be using our analysis skills to do that. And so to this end, we use fractal energy trading. So if you don't know what this is, I'll give you just a quick primer. To me, markets don't do overbought and oversold anymore. And they haven't for quite some time, especially since the days of QE, dollar printing. Markets move differently now. So similar to how nature works, markets will move as far as they possibly can, then rest and consolidate. And this process repeats indefinitely. So the way you can think of this is if you were going to, let's say you're going to climb a mountain. And let's say you had a goal of summiting that mountain in one day. It's very unlikely that you're going to be able to sprint all the way up the mountain before you're going to be clutching your sides and saying, oh, I can't go another step forward. What are you going to do? You're going to rest. You're going to consolidate. And then once you're ready, maybe take a drink of water, boom, off you go again. And you go as far as you can, and then you're going to consolidate. And then with the summit in sight, you make one final sprint. You arrive at the top, you collapse, but you made it. But this is how markets work, guys. This is how markets operate. Range expansion, range contraction. This is how they work. They don't work with overbought and oversold, and they have not for a long time. So we use what's called a fractal energy study, which is essentially the choppiness index, which does not live on Thinkorswim, by the way. You have to find the custom code for that, which we have. So you can think of this as just almost like a fuel gauge to the market, full and empty. So what we're looking for is when we see conditions that are full of energy, this is where we have a lot of non-linear behavior. We're expecting a breakout or breakdown from that level, and a break above those highs shows that we're about to get a good strong move here. So we're looking for full energy conditions like this, where we're expecting a break up or breakdown. We use our price skill analysis to know which way it's moving from there. Conversely, we can also take the other side of the coin when something is exhausted, and this is a great time to sell. After exhaustion, this is a great time to sell iron condors, right? Iron condors is a great time to sell when exhausted. And then once it's built up energy again, look out, because you're about to get that next freight train move. So we use both sides of this: range expansion, range contraction. So we're going to initiate our range-bound options offense when the conditions appear likely to consolidate or reverse. And then we're going to pause when conditions appear favorable to trend. That's why I didn't take any positions this morning, because we're seeing mean reversion. We're seeing that price fade back down again, and that can be a very dangerous move. Also, we'll take care to avoid trading before big economic announcements. We didn't trade in front of CPI last week. We traded after CPI. We actually did trade in front of PPI today, but I didn't think that it was going to be as big a deal as the CPI, so I was willing to go for it. So we placed positions outside of the expected move and known support or resistance price levels. So we can use a little bit of TA there. Would place positions at strike prices that correlate to specific option probability and delta. We want to do everything that we can before we enter our positions to stack probabilities in our favor. Let me ask you this. If you were running an insurance business that sold, say, hurricane insurance or some type of flood insurance, would you be selling that in front of Hurricane Ian a couple months ago? Probably not, right? You'd be saying, no, I think we're going to stop selling this. We're not going to take any new policies right now until this thing blows over. You got to be smart about it. So essentially, we're being an insurance company. You don't have to take every policy that comes along. You don't have to trade all 252 days a year. Now let's talk about defense. This is the big difference between an experienced trader versus a new trader. A new trader is going to work on offense. All they care about is the offense because that's the glory, right? So putting positions on is all you care about. And I know because I was there before. But once you spend some time and once you get run over a couple of times, you say, oh, defense is where the game is. Think about option trading as almost like a football game, like kicking off, because essentially that's what you're doing. When you accept that credit by selling a trade, you're essentially kicking off to the market and you're protecting your goal line. It's exactly the same thing. Now, I've got a couple of definitions here. Static defense is one that is set up ahead of time before the trade is entered. I'll show you a couple of examples of this in a minute. An active defense is one that is played during the duration of the trade. So it's you're actively defending something in a dynamic fashion based on the price movement. The defense necessary for an iron condor will depend on the structure of the trade to begin with. Different structures of the iron condors will have different needs for defense. Remember, I talked to you about a low probability condor. This can be a wonderful trade for setting up. If you're really, really freaked out about the risk of a certain event coming up, like you're convinced that Putin's going to do something out in Ukraine, or you don't know what's going to, well, certainly you could just choose not to trade. That's one way to do it. But if it's just normal market action, but in the back of your mind, you're like, something's terrible is going to happen. I don't know what's going to happen, but I can't sleep at night with the amount of risk. This trade is great for that because, again, you define your risk by the position size. The worst that's going to happen is there's your risk right there. And it's $250 per contract. It's reasonable, right? And that's a 2% position on a $12,500 account. So you can very accurately define what your risk is, and you can sleep at night through these types of trades. So it doesn't require any additional defense, or you can choose to do different defense. But to me, this is the static defense for this type of trade. However, if you go out with these super wide iron condors, essentially what you're doing is you're acting like the artillery in an army. You're miles behind the line and you're under no threat on any given moment until somebody flanks your front line and comes and attacks you directly. And then you're defenseless. And so that's kind of the same thing with a high probability iron condor. You cannot let this happen. You cannot let the price go all the way into the black hole over here, because for every trade that you win, or every trade that you lose, you're going to eat up the profits of at least 10 other ones, 10 profitable ones. And it's a soul crushing event that we don't need to learn from. So avoid this at all costs. So there's three ways that I can do static defense. So first of all, I can say, here's my short strikes. Here's my call spreads, short strike. Here's my put spread, short strike. If it gets within X number of points, say, for instance, like maybe 50 points, if I'm within 50 points of the calls, and maybe I'm going to go within 75 points of the puts, then I'm going to exit. So that's one way. It's a very simple way to do it, although it will generate a lot of variability to your exits. For those of you that trade for a while, you understand why. However, we can tighten this up if we want to. We can say, all right, I'm going to close at a defined delta. So maybe if I'm putting this trade on with a delta of 4, if it gets up to a delta of, say, like 20 or 25, that's unacceptable. That's my threshold. You can define that as a static defense. And then lastly, you could also, and this is really very similar to that, you can also close on a defined debit. So if I enter something at a 15-cent debit, maybe if I say, look, a 4x of that initial credit. So if I entered a 15-cent credit, I want to close at a 60-cent debit. So whatever your multiplier is for that. And again, that will produce fairly consistent results for you. Understand that there's no perfect static defense, one that is too risk averse. So if you see the price coming in your direction, too risk averse, and you'll suffer from early exits that would have worked out fine. But we can take the opposite side of that. One that is too aggressive will allow holding through deep attacks. And so you feel great about that. Hey, I just beat off that great attack and I'm still in the trade. But when you do take an exit, they're usually a lot more expensive. Find one that works best for you and stick with it, is what I would do. Now there's active defense. And active defense requires much more skill and judgment to employ. It sounds cool to, hey, we're doing active delta neutral hedging strategies, but there's a very good chance that a poor application will actually increase your losses and turn winning trades into losers. So there's actually a way for you to lose much more. And actually, one of the most common ones that I hear from people, and I hate this, is that when somebody is doing, let's say we have a vertical spread and this is a short call, and then this is a long call. So this is a call credit spread. And if the price comes skyrocketing highwards, so what people say to do is, well, what you do is you just close down your short call and let the long call run. And I guarantee you that what will happen to that more often than not is that you'll see a little bit more of an attack, and then you'll see it actually drop like this. And so what happens is you've gone from being a neutral trader with defined risk, and you've closed out your call at a very expensive price, and then you're basically turned yourself into an out-of-the-money long call trader for the rest of that trade, which is incredibly aggressive and very low probability. And so you'll probably end up increasing your losses on the entire trade instead of doing it the right way. So never spin out of these things, never break up a vertical spread unless you're doing it because you've closed out your short option at next to nothing and just leaving the long as a lottery ticket. Another thing on active defense here is the traditional problem is setting up the trade and having the price attack one side with a freight train trend. So you can see it coming from a long way off. We've seen this uptrend coming for a while now, yet there's nothing you feel you can do about it. So what happens is you narrow your focus on what you're afraid of. You're checking your phone every 5 minutes. You can't let go of it. You can't sleep. Isn't there something that you can do during this if you see this trend coming from a long way off? The problem is we stick our head in the sands and we just pretend like, oh, I hope it goes away. I hope it goes away. But all you're going to do is you're just going to burn all this energy on your fear. You're going to be blind to any other opportunity out there. So the simplest method of active defense is simply just to get the position gone. And I will do this all the time. I will shut down trades for break even for a small debit, as long as they don't take a loss on the entire trade. I will get out of there because, again, 252, there's 252 days to trade every year. So I found that the best hedge is the one that's placed with a very good reward to risk. It's inexpensive, won't cost you much if the hedge ends up being unnecessary. Like an out-of-the-money vertical spread is one way to do this. It's got asymmetric reward to risk. It's a low probability, but it's cheap. So if it doesn't work out, it's not going to be a big deal. So one last thought on defending a trade before we get into wrapping up here. Do not use technical analysis to defend a trade. Once you're in the trade, use the numbers. Only make exit decisions by the numbers, whether it's the debit, the delta, the point differential, whatever it is. But don't say, well, the market's overbought, and so therefore it has to pull back. It doesn't work that way. And I'm here to tell you that I did that once, and all I had to do was do that once. So let's go through the system really quick, and then we just got a couple of minutes for questions. So we are going to trade SPX options because they are the biggest, the most liquid things out there. Although the spiders are not bad. Spiders are not bad now, and they've got 5 times a week too. We're going to add positions every day that we can. 5 days trading out, or 5 trading days out in time. We're going to be creating high probability iron condors. We'll use 10 wide with smaller accounts, 25 with larger accounts. We're going to ensure a minimum credit of 25 cents for narrow. This is credit per side times 2 for an iron condor. So we're getting 50 cents for the entire iron condor for 10 wide and 80 cents for the 25 wide iron condors. We're going to seek a 2% return on risk per trade. So we're just chipping away every day, chipping away. We're going to get that market by death by 1,000 cuts. Immediately, we're going to set up a 10-cent exit debit on each individual vertical spread. So we're going to close down each side individually because it's quicker to do it that way. So we're going to avoid entry just before big economic announcements. We're going to avoid entry or go with lower risk entries on days when the market energy shows high probability of a big move coming. We're going to set up static risk management by setting individual credit spread exits at the time of entry. So whether that's the point differential, the debit, or the delta. If price is in a longer term downtrend, we're going to seek counter trend rallies to buy out of the money, put debit spreads as a proactive trend hedge. That's optional. And so we could do the same thing for call spreads if we have a strong rally. It would be better to do that during traditional bull markets and not through a bear. There's so much movement that right now doing hedging on swings is probably unnecessary. With the exception of the low probability, I will adjust or roll those. But for the high probability, there's too little time, too much gamma risk. It's not worth rolling these. So they're one and done. So you've got to track these things. You got to track them. You got to get the numbers down for these things like crazy, right? So you got to take all this data. So this is the tracking sheet that we use live in the room. And you have to learn from that and understand what's working, what's not. So here's an example that we entered on Friday. So we entered this on Friday after the CPI, and the Friday's still rallying up to 4,000 on the S&P. So we entered 2 credit spreads here. One was a put credit spread for $40 a credit, and you can see this, that's the short strike down there, and that's basically below support. And then we also entered the call spreads up here way above resistance. I felt resistance was going to be 4,100. So we established defensive thresholds above and below the credit spreads, and then put those 10-cent limit orders in. And then what happened was the next trading day, which was Monday, yesterday, we entered here on Friday, and then early on, I think it was like noon. Noon was our exit on the put spreads, and then the price comes down here by the end of the day, and near the closing bell, we got out with. So here's typically, this is rolling in the trade for about a full trading day. This is pretty common to see. Technically there's 2 trading days. I believe it's like 2.6 days is our typical hold time, and that's even over weekends. So what happens is the intraday volatility moves around enough with these things to knock out one side and then the other. Our performance since service inception in June was, let's see, we're 126 out of 138, 91.3%. Our profit factor is 1.6 right now. For every dollar we lose, we're making $1.60. So as long as we maintain a profit factor above 1.5, that's our goal, this system will print money. And these numbers have achieved during some of the toughest tape in the last 20 years. So again, we're also using the delta neutral iron condor strategy and using different active defenses for that too. So if you don't like the high probability stuff, if you're nervous about that, we've also got a low probability in the process. Okay, so let's talk about next steps here, and then I'll finish up for today. Nothing I've talked about in this presentation is new. Traders have been selling iron condors and the SPX for decades. So why is it that so few are profitable? Some people win some trades, they lose some trades, they give up. Perhaps they lack the discipline. Perhaps they don't have a system. More than likely, they'll lose confidence and give up after the first loss. Confidence must begin by gaining knowledge and then applying that knowledge to learn to win. If you need one piece of this puzzle, or maybe several pieces, then consider joining me at the 12-minute trading daily target 100 service. We're trying to do this in 12 minutes a day. We're going for 100% return per year by trading these trades at 2% goal per. So we meet as a team every day in a live trading room. That's me down there hiding in the corner. And we meet for about 45 minutes a day at 11 o'clock. We enter trades every single day to give you reps in the system. If conditions do not warrant a real entry, I'll do it in sim like I did this morning. All live trades are posted in our class portal with email and SMS notifications and backed up by a live tracker. So you can see the portal updates here. You can see the course that we've got online, as well as this is a typical daily trade update. This is the trade update from the one that I did on Friday, as well too as the SMS that we've got. Each day in the trading room, we do a full read on the market with an evaluation of current inventory, what we're doing with current positions, new trade entries. Think of every day as a live coaching session with me. So today's webinar special, 2 weeks of free trial. You can kick the tires on this thing. Join us for 2 weeks and learn everything that we do at 12minutetrading.com/T100ST. Right. So I don't know if we can put that into the chat box here. So spend 2 weeks with me live. If it works for you, it's only $147 a month to stay, which you can make up in 2 or 3 trades. Cancel anytime with no hassle. 12minutetrading.com/T100ST. So please don't miss out on the free trial. It's going to be taken down soon. So no risk to try it out. And if you have any questions, I've got just about 2 minutes here, and then I'm going to have to yield my time back for the next presenter. So you can, if you don't get your question answered today, if you think about it, talk to me at doc@12minutetrading.com. Okay, David, I'm going to yield back to you, and we'll see if there's any questions in the room. But otherwise, we've only got like about a minute left. So if I don't see something in the room, appreciate being able to have a chance to talk to you folks today. Thank you very much for your attention, whether you're joining us live today or watching this on replay. And I look forward to working with you live.